Hello and thank you for joining us today. Risk assets rebounded since the end of March amid a buoyant earnings season in the US and a very sharp rebound in oil prices. Meanwhile, 10-year Treasury yields jumped 20 basis points, and this has fueled the US dollar against the euro and the Japanese yen. Such FX movements lifted European and Japanese equities since their market is highly sensitive to currency movements. According to some metrics, risk appetite is back in Q2, but the volatility regime in equities stays structurally higher compared to the levels recorded in 2017, suggesting that investors remain cautious overall. Hedge fund performance has been flat according to several benchmarks since end March. The industry has deleveraged during the market sell-off in February and March and has thus not fully captured the market rebound in Q2 to date. From the perspective of hedge fund strategies, event-driven global macro and relative value arbitrage outperformed, but their outperformance was offset by the underperformance of long-short equity and CTAs. Our views have marginally changed lately. While we continue to express an overweight stance on event-driven and fixed income arbitrage and a neutral stance on global macro and long-short equity, we upgraded CTAs from underweight to neutral. This upgrade is taking place while we find low beta strategies increasingly appealing in a context of a higher volatility regime in risk assets. CTAs have also exposures to traditional asset classes that are much more balanced compared to a few months ago when their performance was heavily reliant on the momentum in equity markets. From that perspective, CTAs are back as a diversification strategy. Thank you for your attention and see you next month.